Hello, it's Chew Dog Charts. Unfortunately, I have bad news for everybody. After that big blowout birthday party for Snow Firewall and everybody's got a hangover, it's time to get back to work. We got to go find some money. So I have something for your consideration. Enbridge Energy Partners and the pipeline giant Enbridge. So here's the story. EEP went through a brutal year in 2017, shedding more than about 45% of its value. Declining conditions in the energy market fueled the sell-off by putting pressure on the master limited partnership's finances. That tightening spot drove the company's parent, oil pipeline giant Enbridge, to complete several strategic transactions with its MLP to shore up its financial situation. That plan seems to be working, though, given Enbridge Energy Partners' guidance for 2018 and beyond. However, even though it's starting to turn things around, the valuation hasn't followed. Because of that, it's selling for a ridiculous cheap price. So we just have to take a look. In January 2017, over a year ago, Enbridge Energy Partners issued a disappointed outlook for the coming year. The MLP's guidance was that distributable cash flow, or DCF, would be between $750 million to $800 million, which was down sharply from the year before when DCF was $942 million. Two factors drove that weaker outlook. First, the company noted that further weakening of its natural gas gathering and processing business due to lower realized commodity prices and volume flows would impact cash flow. In addition, EEP noted that a reduction in drilling activity in the Bakken region has resulted in reduced revenue projections from portions of EEP's existing North Dakota liquids assets. Because of that declining cash flow, the company was no longer pulling in enough money to cover its distribution to investors. That led the MLP to announce several strategic transactions with Enbridge in April, including selling its natural gas gathering and processing business to its parent and cutting its distribution 40%. That decision helped put the company's financial situation on firmer footing. This improvement was evident in the company's guidance for 2018. It noted that DCF should be in the range of $775 million to $825 million, which is enough to cover its reset payout by 1.2 times, which is fairly strong. That's excellent news because it suggests that the company's 11.8% yield distribution is sustainable, especially considering that the company also expects to grow DCF per unit by 3% per year through 2020 due to acquisition options and contractual volume growth it has coming down the pipeline. One reason EEP offers such an attractive yield these days is that the company currently sells for a relatively low valuation. Assuming the midpoint of its 2018 guidance, EEP sells for about 8.7 times DCF. And for comparison, Enbridge's other MLP, which is Spectra Energy Partners, currently sells for about 11.8 times DCF, while many other MLPs trade at more than 15 times DCF. So there's two potential ways that investors can win with Enbridge Energy Partners. First, simply collecting its nearly 12% yield payout alone should produce some market-beating returns, especially when also factor in the expectation that DCF will grow at about 3% annual rate for the next few years. In addition to that, as EEP's growing excess cash pushes down its leverage ratio, it should help nudge its valuation up closer to the peer group average. This combination of income and a steady improvement in the company's valuation as the weight of its debt lifts has the potential to fuel market-crushing returns in the coming years with further upside if the company makes an acquisition or completes some high-return expansion projects. So that's upside we want to take a look at. And we're going to look at both EEP and its parent, Enbridge, which is ENB. So let's go to the charts. So the chart we're looking at is the 20-year monthly chart for Enbridge Energy Partners LP, and the symbol is EEP. With a current price today at $15.16, we can see that we were way up here at over $40 a share, came down and bottomed once here in early 2016 with a bounce up to just over $25 a share in late 2016, but we're right back down here in early 2018 at this point with another bottom there. So we'll take a look at the charts and see what we see with regard to the second bottom here, and that's going to come up here immediately in the MACD. And this is a great formation that I like seeing, and I'll mention that, and I've mentioned it before, but basically what's happened is we've had a bottom here in early 2016 with then of course the rise and then the subsequent fall. But here we are. We came here in mid 2017 through now early 2018, and we have improvement, a slightly higher low. So although it's slightly higher, the time frame here I like, which is not quite 2 years, but definitely over a year and a half. So it's had plenty of time to bottom here, and within the next few months, I would imagine that the fast line is going to move through the trigger line here real soon. Moving on down to the MACD histogram, we also see that improvement here with definitely a much more significant low in early 2016 and only a moderate low here in mid 2017. So things are improving, and that is also reflected in the momentum indicator here as well, moving on up. And we're going to see the same thing in the price rate of change with the fast line ready to move through the slow line, hopefully here in early 2018. The relative strength, we're still at a moderately low 32.15 measure. However, that looks like we've also bottomed here, and we have an upward move, and I would imagine that perhaps is going to continue. And then the stochastic also shows real good improvement, although the bottom here is not higher than the previous bottom. We have the fast line moving through the slow line here at this point in oversold territory and perhaps moving on its way up. And then the volume looks relatively healthy here. Moving on down to the Williams, and the Williams is showing us much the same as the stochastics with the double bottom here, and then the upward move heading toward the midline 50. So back up here into the price chart, we can see that we've had a very, very strong trend downward here over the past couple, say 3 years, but the oscillators such as the MACD, in my opinion, show that the company is turning around. So this is definitely something for your consideration. Again, I don't own this stock. You need to conduct further fundamental analysis on this for your own purpose. So let's now go take a look at the parent company, Enbridge. And the chart we're looking at here is the 20-year monthly chart on Enbridge Inc. common stock, ENB, which is the parent company of EEP. And although the basic discussion of this video was for EEP, I wanted to take a look at Enbridge ENB simply because this chart is also very strong. As you can see here, we topped out at this point and came down to a bottom in, say, early 2016 with a subsequent rise and then another bottoming process here. And you'll note that in the previous stock we looked at, the bottom was at or slightly below the previous bottom, but here we have an improvement in this bottom. And I think you can see that the strength of This stock here is also shown in the MACD, where we have the bottom at this point here, and we have another potential bottom here. Looks like the fast line is going to move through the trigger line here relatively soon. So this to me is even stronger than the previous stock. Moving on down into the histogram, we also show a very negative decline here. However, the decline at this point is minor. So very good strengthening. Into the momentum indicator, showing much the same. Into the price rate of change, also good strength showing here. Into the RSI, we're at a slightly higher level of 46.95, and it looks like perhaps a bottoming process here and a move to the 50 and perhaps higher point. Into the stochastics, again, much the same. A bottom here and then a bottom here. Good improvement with the fast line about to close through the slow line and head up. And into the volume, much the same, looks relatively healthy. And the Williams also as well, the double bottom here and then the bottom here, and then certain improvement up to the 50 or midline. And back up here into the price chart one more time. Shows very good strength. We're heading into the 20 and 50 EMA, and it looks like we might trend along sideways for a little while unless it decides to break up or through the 20 and the 50 EMA, and I would imagine that's going to happen here within the next, say, couple of quarters or so. So that's our look at both Enbridge Energy Partners, EEP, and the parent company, Enbridge, ENB. And lastly, I'd like to give a shout out to all the new subscribers. We're up to 10 subscribers, and I appreciate each and every one of you. And for the new subscribers, I'd like you to know that we are on a path. This is just not one video and you're done. We're on a path because the stock market is on a path and it changes all of the time. We are elevated. So we're going to be looking for the top in that market. We're going to look for the tapering of central bank funding, which is pushing up the stock market. At the same time, we're going to try to look for cheap stocks, and it's getting very hard to find cheap stocks just simply because of the elevated level of the market. So we're going to look for that potential top in the market. And then we're going to follow it down, and ultimately we're going to look for the bottom of any correction or any crash, because we want to deploy cash at that time. Because when you deploy cash at a bottom in the market and you ride it back up, that's when you can get rich. So for now, that's Chew Dog Charts. Thank you.